Have you ever stared at your pension fund documents, feeling like you are attempting to decipher some mysterious code written by hyperactive money managers? You are definitely not alone. When most individuals check their investment dashboard for the first time, they encounter a chaotic pile of fund titles that feel like they were picked by a random text generator. Large cap growth, international blends, emerging markets, and target date options clutter the screen. Yet hidden in that forest of jargon usually sits the S&P 500. Now, if you are like the typical worker, you have heard this name mentioned more than weather reports during a hurricane, but you might not actually grasp what it entails or why it matters to your wallet. Perhaps you see it scrolling across the bottom of news broadcasts during a market rally or a sudden crash. Maybe that one coworker who thinks he is a hedge fund genius keeps bringing it up in the break room. Either way, you are likely questioning if this famous index is a tool you should actually use or just another bit of financial noise intended to make you feel confused. Well, here is a reality that might shock you. This index is not just a bunch of random businesses that some banker selected during a long lunch. It is actually the primary heartbeat of the American economy, and mastering how it works could represent the gap between a luxury retirement and working at a retail counter until you are 90 because you felt investing was too intimidating. My name is Noah, and I spend far too much time analyzing assets, growth curves, and the reasons most people would rather scrub floors than read a prospectus. If you want to learn how to manufacture wealth without needing a master's degree in economics, make sure you hit that subscribe button and like this video if it helps you clarify your financial future. Here is what most folks miss about long-term planning. The typical professional will switch careers several times, and every transition forces them into a new bucket of investment choices that look nothing like their previous plan. One firm might offer 10 options while another provides 50. Some have aggressive titles while others sound incredibly safe and boring. Yet in almost every scenario, that S&P 500 option is waiting for you. The reason this specific fund is everywhere isn't because the industry is uninspired. It is because it represents a truly unique mechanism in the world of money. Think of it as the ultimate championship for American corporations. Instead of a trophy, we are ranking which businesses are actually generating the most value. But before we explore why this is so effective, let me ask you a quick question. When you visualize the most dominant companies in the country, which brands appear in your mind? You are likely thinking of Apple, Microsoft, Amazon, or Google. These are not just household names. They are the engines that changed how we communicate and spend. Well, the truth is that these giants are the backbone of the S&P 500. When you buy into this index, you are grabbing a small slice of all of them simultaneously. Now, does this sound too simple to be effective? Why isn't every single person just doing this if it is so powerful? These questions are vital because they explain why the S&P 500 is the secret weapon for anyone aiming for a massive nest egg. This index is essentially a thermometer for the corporate world. Just as a reading tells you if you need a jacket, this index tells you how healthy the business landscape is. But unlike the weather, which changes by the hour, this data helps you spot decades-long wealth trends. Here is the fascinating part. This list of 500 companies is not chosen at random. There is a specific committee of experts who filter businesses to see who earns a spot in this elite circle. Think of it like a gatekeeper for a prestigious club, but instead of social status, they are looking at market value, cash flow, and overall stability. To enter this club, a company must satisfy strict rules. They have to be based in the US, possess a multi-billion-dollar valuation, and show actual profit in their latest reports. They also must have been public for at least a year to ensure they aren't just a temporary trend. This rigorous screening is exactly why these funds have historically dominated. You aren't just gambling on random stocks. You are backing proven winners that have survived the toughest competition. It is like having a professional scout pick your starting lineup, but instead of a game, the prize is your financial independence. But there is a detail about how this works that might catch you off guard. Even though there are 500 companies, they aren't weighted the same. The more valuable a firm becomes, the more it moves the needle for the whole index. So when a giant like Nvidia has a massive growth spurt, it carries the index much higher than a smaller firm could. This means the top 10 companies actually drive a huge portion of the performance. We are talking about the tech titans and massive conglomerates. When they win, you win. Now, having your money concentrated in these leaders isn't a flaw. These are entities that have mastered the art of generating revenue through every type of economic storm. They have adapted to new tech, outlasted rivals, and expanded globally. Investing here is essentially betting on American ingenuity. But here's the part that many financial advisors won't tell you because they can't sell you a high commission product if you know it. This simple index has a track record that makes professional stock pickers look amateur. For decades, this boring strategy has beaten the majority of active funds managed by people with Ivy League degrees and expensive offices. Think about that reality. You have teams of experts working 80 hours a week trying to predict the next big thing. They get paid millions to try and beat the market. And yet, the majority of them fail year after year. It is like a professional athlete losing a race to someone who just walked in off the street. The data is quite embarrassing for the high-fee industry. Research shows that over 15 years, nearly 90% of professional managers failed to outperform the S&P 500. That means if you handed your money to 10 experts, 9 of them would have given you a worse result than if you had just clicked buy on an index fund and gone to sleep for a decade. How is that possible? How can a mindless set of rules beat human intelligence? The answer is found in the efficient market hypothesis. While that sounds like a dry textbook term, the idea is simple. Stock prices already account for all known information. When a company announces a breakthrough, the price adjusts almost instantly because thousands of smart investors are watching every move. It is like trying to find a lost diamond on a crowded beach. Someone is going to spot it before you even get your sandals off. This leads us to a core truth of building wealth. It isn't just about finding the best stocks. It is about avoiding the traps that drain your account. One of the biggest wealth killers is paying high fees for mediocre results. When you use an active fund, you might pay 1 or 2% in annual costs. That sounds small, but the math is terrifying. If you have $10,000, you pay $200. But when that grows to $1 million, you are paying $20,000 every single year. You are basically buying a stranger a luxury car every year just for the privilege of them underperforming the market. These costs also compound. That money taken for fees isn't just gone. It is the loss of all the future growth that money would have generated. Over 30 years, these fees can literally cost you hundreds of thousands of dollars. This is why the most famous investor in history, Warren Buffett, tells everyone to just stick with index funds. He even made $1 million bet with hedge fund managers that they couldn't beat the S&P 500 over 10 years. Even with all their tools and secret data, the professionals got crushed. The index returned over 7%, while the experts struggled to clear 3% after their fees were taken. The beauty of this approach is that it removes human ego from the equation. You don't have to worry about a manager making an emotional mistake or a fund changing its strategy without telling you. You get a predictable system. When the economy grows, your wealth grows. Over the long haul, American business has shown an incredible ability to pivot and thrive, which leads to consistent gains for you. Let's look at the actual numbers, because this is where the theory becomes a reality. For nearly a century, the S&P 500 has averaged about 10% annually. Yes, some years are terrible and some are amazing, but the average is steady. If you invested $1,000 a month, starting in your mid-20s, by the time you retire, you would have put in less than $500,000, but your balance could be over $2.5 million. That extra $2 million didn't come from your labor, it came from the power of compound growth. This mathematical snowball is the most powerful force in finance. If you start at 30 and just max out a basic retirement account, you could easily end up a millionaire by 65. That is the reward for having the patience to let the market work. Now, I know 10% sounds high when you see a scary headline about a crash, and you are right to feel a bit nervous when the red numbers appear on the screen. But here is the secret. Those crashes are actually a gift if you are still in your earning years. Think of a market dip as a massive sale at your favorite store. When prices drop, your monthly investment buys more shares. When the market eventually recovers, and it always has, those extra shares become the fuel for your future wealth. Successful investors don't panic during a downturn. They get excited because they are buying assets at a discount. It is like staying on a bumpy flight because you know the destination is worth the turbulence. But you will still hear critics. Financial advisors will claim you need sophisticated strategies as you get wealthier. They will show you complex charts that seem to prove they can time the market. What they won't show you is the impact of taxes and hidden costs on those strategies. Complexity sells because it makes the advisor look necessary. But in the world of money, the simplest path is often the most profitable. You have to decide if you want to look clever or if you want to be wealthy. Sometimes, being wealthy means choosing the boring, reliable path. The S&P 500 isn't magic. It is just a way to own the best parts of the economy without the stress of picking individual winners. Whether you go for a total market fund or a growth-focused version, the key is staying the course. The best strategy is the one you can actually follow for 40 years, not the one that sounds impressive at a party. If this helped you understand your 401k better, please give this a like for Prime Noah Invests, and let me know in the comments if you are Team Index or Team Active. See you in the next one.